My fellow investors, fellow Jamaicans, welcome back to the Money Talk JA channel. Today, we are tackling one of the biggest, most debated questions in the world of finance. What is the perfect investment portfolio allocation? I know you probably came here looking for a magic number or a specific carved in stone pie chart, like a 40% in this and a 20% in that. But I've got a truth bomb for you right out of the gate. The reality is that there is no single perfect allocation. Not for me, not for you, not for your neighbor, and not even for the most successful hedge fund managers on Wall Street. Why? Because a portfolio is not a static object. It is a living, breathing strategy that has to be built around the most unpredictable variable in the equation: you. Now, in this video, we're going to discuss why stocks remain the most reliable wealth builder over the long term. We're also going to be talking about how real estate and rates provides a necessary hedge against inflation. We're going to be touching on the wild card: how to safely allocate to cryptocurrency without blowing up your account. We will be talking about why cash is a strategic asset, not just a place to store spending money. And to bring everything together, we are going to talk about how to adjust the percentages based on your age, your risk tolerance, and your time horizon. If you want more videos like this, please hit that like and subscribe to the channel right now. It will really help our community grow. Plus, you will receive notification when we release more content like this in the future. Before we dive into the specific sectors and percentages, we have to talk about the why behind your choices. Your perfect allocation is dictated by your individual circumstances, specifically your age, your financial goals, and your risk tolerance. This is what we call the sleep test. If your portfolio is so aggressive that you cannot sleep when the market drops 5%, you have failed the test. Your age is perhaps the most significant factor. If you are 25, time is your greatest asset. You have decades for the market to recover from downturns, meaning that you can afford to be more aggressive. But if you are near 60 and you're looking to retire in the next few years, your focus must shift from how much can I grow to how much can I sleep. You cannot afford a 40% market crash right before you stop working. Now, with that foundation set, let us get into the actual sectors you should be looking at and how to think about the weight you give to each one. Now remember, this is not financial advice. Think of it more as a roadmap for your own research. The core engine of almost every successful long-term portfolio is stocks or equities. This is where you own a piece of the world's most profitable companies. Stocks are your primary tools for beating inflation and building real wealth over time. In a growth-oriented portfolio, this is usually your largest bucket. For a young investor, an allocation of 70 to 90% in stock is not uncommon. Now, as you get older, this might slide down to about 40 to 50%. But don't just buy one or two companies. You want broad exposure. Think about index funds or stock market ETFs that gives you a slice of everything from banking giants to healthcare providers. Then we have fixed income, primarily bonds. If stocks are the engine that moves the car forward, bonds are the seatbelts and the brakes. They typically pay a fixed interest rate and are generally less volatile than stocks. When the stock market goes in a tailspin, bonds often hold their value or even go up, providing a crucial cushion. A classic balanced portfolio used to be like 70-30 split, 70% in stocks and 30% in bonds. While this has changed lately with lower interest rates, the principle remains. If you are conservative or you're near retirement, having 20 to 30% of your money in bonds can prevent your total portfolio value from evaporating during a recession. Next, let us talk about real estate. This is a powerful sector because it is a hard asset. It has intrinsic value and often moves independently of the stock market. Real estate provides two paths to wealth: monthly rental income and long-term price appreciation. It's also a fantastic hedge against inflation because as prices rise, so do rents and property values. A solid allocation here is often between 10 to 20%. No, you don't have to go out and buy a physical apartment building to do this. You can use REITs or real estate investment trusts, which are companies that own and manage property. You can buy shares in a REIT just like a stock, making this sector accessible even if you only have a couple $1,000s to start with. Now, we have to talk about the new kid on the block, cryptocurrency. Whether you love it or you hate it, digital assets like Bitcoin, Ethereum, and Solana have become a legitimate asset class for many investors. They offer the potential for astronomical returns, but they come with heart-stopping volatility. For most people, crypto should be viewed as a speculative sleeve of your portfolio. A safely aggressive allocation is usually between, say, 1 to 5%. If Bitcoin goes to the moon, that 5% will significantly boost your net worth. If it goes to zero, yeah, it hurts, but it does not destroy your retirement. Only put money here that you are mentally prepared to see drop by 80% overnight. We also cannot forget commodities and precious metals like gold and silver. For centuries, gold has been the ultimate store of value. It does not necessarily grow like a company does, but it does hold its purchasing power when currencies lose theirs. Many investors keep 5% of their portfolio in gold as an insurance policy against total economic chaos. And finally, we have the most underrated asset of all: cash. And look, I am not talking about the money in your checking account for groceries. I'm talking about a strategic cash reserve within your investment portfolio, usually between 5 to 10%. Cash gives you two things: peace of mind and dry powder. When the market eventually crashes, and history tells us that it always does, having cash on hand allows you to be a buyer when everybody else is a seller. It is the ultimate opportunistic tool. Without a cash allocation, You are forced to watch great deals pass you by because all of your money is tied up in the falling assets. So, how do you put all of this together? If you are young and you are hungry, you might look at 80% stocks, 10% real estate, 5% crypto, and 5% cash. If you are mid-career, maybe you shift to like 60% stocks, 20% bonds, 15% real estate, and 5% cash. The perfect mix is the one that aligns with your timeline and keeps you from panic selling when things get bumpy. The secret sauce to making any allocation work is rebalancing. Once a year, you look at your percentages. If your stocks did so well that they now make up 90% of your portfolio instead of 70%, you sell some of the winners and you buy more of the underperforming sectors to get back to your target. This forces you to do the one thing every investor wants to do: buy low and sell high. Building the perfect portfolio is not a one-time event. It is a long-term process of adjustment and discipline. Start with these sectors. Be honest about your risk tolerance and build a plan that works for your unique life. So now it's over to you guys. Tell me what you think about the asset allocation portfolio that I just described. Drop your thoughts in the comments below. And before you go, my fellow investors, quick update. Money Talk JA now has a newsletter. Hit the link at the top of the description to sign up to join our growing community and make sure that you never miss an update. Thanks for watching, and click the link on screen now to watch another Jamaican financial content. Catch you in the next one.